All right, let's break down Supermicro Computer Inc., ticker SMCI. The U.S. markets are closed for the week, and Friday's session on November 14th, 2025, saw the stock finish at $36.42. That was a decent-looking pop of 3.79% for the day. Then, in after-hours trading, it tacked on another 0.91%, adding 33 cents to land at $36.75. Now, when an investor, especially one doing self-investing, glances at that 3.79% gain, the immediate expectation is, oh, nice, a solid, healthy green day. They might look at the $36.42 price, see the word computer and AI in its description, and think this is some forgotten, under-the-radar value play. The assumption is that this is just another hardware company, maybe a white box server builder, chugging along. The reality, however, is that this $36.42 price and this small 3.79% bounce are not signals of health. They are the statistical noise in the wreckage of what was one of the most explosive and now one of the most tragic stories in the entire AI sector. This $36 is a scar. This isn't a value play, it's the grim aftermath of a catastrophic multi-year collapse in credibility, a stock that has fallen from over $300 in 2023. This 3.79% gain isn't a recovery, it's a dead cat bounce on a company that was supposed to be the king of AI hardware. For years, the market has been defined by one narrative: AI. We've all seen what it's done for Nvidia stock, turning it into one of the largest companies on Earth. We've seen Apple stock pivot its entire marketing to focus on the AI capabilities of its new chips. The common ground, the universal belief, is that AI is a tidal wave, and the way to profit is to find the picks and shovels, the companies that build the infrastructure this revolution runs on. This is where Supermicro, or SMCI, came in. The story was perfect. The expectation was that SMCI was the premier partner for Nvidia. They weren't just a partner, they were the fastest partner. They took Nvidia's cutting-edge, high-demand GPUs like the H100 and B200 and had the engineering prowess to design and ship the most efficient, custom, liquid-cooled server racks faster than anyone. While Dell and HP were stuck in corporate bureaucracy, SMCI was nimble. The expectation was that as Nvidia soared, SMCI would be its shadow, drafting right behind it, its stock destined for glory. The reality, as this $36.42 price proves, is that the stock completely uncoupled from that narrative and collapsed, even as the AI boom only got bigger. And the question is why? Why would the picks and shovels company fail while the gold rush is still on? The answer is a toxic combination of broken trust, terrifying competition, and a complete failure in financial execution. This is the disconnect that has burned so many investors who bought in on the hype, maybe on their Robinhood app or through SoFi Invest, thinking this was the next big thing. Let's start with the original sin, the accounting scandal. This is the wound that never healed. For a multi-year period, SMCI was in a state of financial chaos. It failed to file its required financial reports with the SEC on time. It wasn't a one-week delay, it was a drawn-out multi-year nightmare. The company was ultimately delisted from the NASDAQ exchange and relegated to the over-the-counter pink sheets. This is corporate hell. For any professional investment manager, say at Fidelity, or for any trader using a sophisticated platform like Interactive Brokers, this is a do-not-touch sign. If a company cannot get its basic accounting right, you cannot trust any number it gives you. Not its revenue, not its profits, nothing. Even though SMCI eventually cleaned up its books and was relisted, that stain of untrustworthy has never, ever washed off. It created a permanent credibility gap. Then, just as the AI boom was taking off and investors were trying to forgive that past, a new terror emerged: competition. The expectation was that SMCI's building block solutions and its engineering speed gave it a deep defensible moat. The reality is that the giants woke up. Dell, HPE, and the massive Taiwanese ODMs like Quanta and WeWin, who build servers for the hyperscalers, saw the multi-billion-dollar opportunity and attacked. These giants have something SMCI doesn't: deep, decades-long relationships with the chief information officers of every Fortune 500 company. They have global, on-site service networks. They are the safe choice. So when a massive bank or a cloud provider is looking to spend $500 million on AI servers, do they go with the scrappy, fast-moving SMCI that has a history of accounting problems? Or do they go with the safe, established, albeit slower Dell? The market is pricing in that they are choosing safe. This brings us to the most recent and most devastating blow: the last earnings report. This is what truly cratered the stock and led us to this $36 level. After all the hype, all the talk of the AI boom, SMCI reported earnings and missed revenue expectations. But that wasn't the kill shot. The kill shot was the guidance. Management guided for the next quarter to be significantly below Wall Street's consensus. This was the ultimate confirmation of the market's worst fears. It signaled in bright red letters that the competition is here and it is brutal. It means that to win what deals it can get, SMCI is being forced to slash its prices. Its gross margins are in a state of collapse. In the middle of the greatest AI boom in history, a time when they should have infinite pricing power, Supermicro is losing it. This is a catastrophic failure of the business model. This is a stock that a standard diversified Fidelity ETF wouldn't touch. It's too volatile, too specific, too high risk. This isn't a set-it-and-forget-it investment for a Fidelity IRA or something you'd want in an automated long-term portfolio like Schwab Intelligent Portfolios. This is a stock for speculators. The people on the Interactive Brokers trading platform are having a field day, with the shorts piling on and the day traders trying to catch these 3% bounces. It's a battleground, not an investment. So, what does Supermicro actually do? In short, they are masters of server architecture. They design and build high-performance, high-efficiency server solutions. Their core concept was the building block solution, a modular design that lets them customize and ship servers for specific workloads like AI, cloud, or 5G, faster than anyone. And their undisputed technical edge, their one true claim to fame, is liquid cooling. As AI chips get hotter and more power-hungry, traditional fans' air cooling aren't enough. SMCI is a pioneer in direct-to-chip liquid cooling, which is more efficient and allows data centers to pack more computing power into less space. This technology is real and it is valuable. The $36 million question is it enough? This leads to the future outlook, which is a perfect split between two extreme possibilities. The bull case, the expectation, is that this is the value trap, or rather, the value buy of a lifetime. Bulls will point out that at $36.42, this stock is trading at a comically low forward PE ratio, something like 6 or 7 times earnings. They will argue that all the bad news is priced in, the accounting is fixed, the bad guidance is a kitchen sink quarter. They'll say the AI boom is still just in the first inning, and that SMCI's superior liquid cooling technology will eventually be recognized as a must-have. In this scenario, the stock is a coiled spring. If they can show just 1 quarter of stable margins, the shorts will be annihilated, and this stock won't just double, it will 5x or 10x. This is the dream that keeps retail investors on their Fidelity mobile app or Robinhood stock trading platform looking for an entry point. Then there is the bear case, the reality check. The bears say this is a classic value trap. The PE is low because the E, earnings, is about to fall off a cliff. That weak guidance wasn't a one-off, it's the new normal. The margin compression is permanent. Dell, HP, and the ODMs are going to suffocate SMCI, pushing its margins down to the razor-thin levels of a simple white box assembler. This company will be permanently relegated to a niche low-margin player, assuming it survives. The $36 price isn't cheap, it's a warning. This is a company with terrible corporate governance, high key man risk around its founder, and a history of destroying shareholder trust. The entire thesis for this stock has been shattered. The battle here is between a rock-bottom valuation and a complete collapse in trust. So I have to ask, do you think SMCI is the single best value trap in the market or the single best value buy? Comment trap or buy below. To wrap this all up, that $36.42 price is the market's billboard for a war between a compelling story and a horrific reality. The expectation was that Supermicro would be the picks and shovels king of the AI gold rush, a true partner to Nvidia stock. The reality is that a toxic brew of past accounting sins, a brutal competitive assault,